Hey everybody, thank you for tuning into the Real Estate Lab. Randy, JJ will be here in a little bit, and Trisha and I will be talking about creative financing. It's one of those things that I think in a situation where we've got these rising interest rates, but people that still want to buy houses, it's a fun conversation to have. So Trisha, why don't you hit us right away with something that you think people need to know in the world of creative financing, something fun.
No pressure.
No pressure. No pressure.
Well, thanks for having me on today. I'm happy to be here. And yeah, we get this question all the time, and people just think that you have to have 20% down to buy a house. And that is not the truth. There's ways to get down payment. There's programs available that allow for minimum down payment. So every situation's different. I like to, talk with people and see what their, true, what they're looking to do, what their goal is. And so, there's a lot of different things. I mean, we can jump into first-time home buyers maybe first.
So I think the question would be, Randy, who do you have more conversations with? People that are having they're moving into a second or third or fourth home, or people that have heard about Austin, they haven't bought a house yet, and they're like, I want to move into a house. Like, who do you think you hear more from?
Yeah, I definitely it's kind of an even divide of people that are relocating to Austin and have previously owned, so it's not their first time to go through that process. And then outside of that, it's certainly some first-time home buyers. Both camps are struggling with the new reality of those interest rates, though, for sure. But I feel maybe to help kickstart off the episode, hearing some advice for some first-time home buyers entering into such a market, I bet that would be a relieving conversation. If you have any tips or advice that would help them out with that.
Yeah, so actually there are a lot of first-time home buyers that need to buy. And it's the next generation. It's the buyers who haven't been able to afford the past couple of years. They've gotten outbid. They've gotten frustrated.
That happens. Ian will be back.
and so this is their time. This is the time to get in there and buy the home. I do not think home prices are going to be coming down. I think they're only going to be going up. I think they even just came out with Austin still appreciating as a whole. So there's no reason to wait. Rent's going up. So this is the time for sure. So one of the best advice I can give is to just have a plan. Even if you're a year out from your lease, let's have a plan on what that looks like when the lease is up, and how much do I need? Do I need to work on my credit? How can I get down payment? What is out there?
That brings me to a really interesting conversation I just had. I have some clients that flew in this weekend. They're not buying a house for 2 years.
Wow.
Oh, wow.
For 2 years, but they're casing the area. They're like, let me come spend some time in Austin. So we're going to go around, look at some restaurants, look at some houses, some neighborhoods, and just kind of get a feel for the area. They know that Austin will be the place. They do have a house to sell, but there's something with the timing. Maybe it's school age children or something like that, where they want to be very ready for this transition. And so I thought, how cool that they are planning this so far in advance. I wish more people had the ability to do that.
Right. And also like the opposite end of that, why not buy now, rent it out, and then move in 2 years? So
yeah, circumstantially it doesn't always work.
Right.
But yeah, that would be great.
Yeah. So leverage is always a good thing when you have other real estate. Leverage the equity in there to buy. So a lot of creative ways is to, get a refinance or a HELOC, which is a home equity line of credit. Get some equity out and use that as a down payment on another home. I know a lot of...
Just to be clear, so a HELOC is on the side of someone who already has a home.
Correct.
Can we, like Randy said, can we start with the first-time buyers? Let's say they've never owned a house, they have no equity anywhere, and they want to get into their first place. I think earlier we were talking and you had mentioned down payment assistance. How feasible is that in 2023?
So down payment assistance, every state has their own, and there's different counties that offer even additional ones. So in Texas, there is a really good one that I like. It's called TSHAC, TSAHC, and it is geared towards first-time home buyers. You do not have to be a first-time home buyer. Most first-time home buyers are somebody who hasn't owned a home in 3 years. That makes you a first-time home buyer. So It doesn't mean you've never.
How many years?
3.
3.
Yes.
Okay, I heard 30. My hearing was off. I was like, 30 years. That's a little bit of time.
Yeah.
Okay, so if you've owned a home, and let's say you sold it, and you've lived in an apartment for a few years because you wanted to make that pandemic money, and let's say it's been 3 years, right? Or you moved, you rented an apartment, and now you're ready. You can still qualify for this TSHAC down payment assistance if you haven't owned a home within 3 years.
Correct. But TSHAC you don't have to be a first-time home buyer. Some
Beautiful.
Down payment assistance programs require it, but most of them don't anymore. And they actually do allow for you to own other real estate. So it is circumstantial on each, scenario. If you're an investor, obviously this isn't for you, but if you have another home, that's in another state.
It's important to know, because I have investors that'll ask, well, what kind of down payment assistance do you have? What?
Well, and again, down payment assistance is for a primary home. This isn't for an investment home or a second home. And this is mainly this isn't creative housing, like a barndominium on a ranch. It's not for those kind of programs and those kind of properties. But yes, so TSHAC is a good one. We have other ones as well, but that one is my favorite. I feel like they're the easiest to work with. They underwrite to the regular loans of Fannie Mae and Freddie Mac. So there's not like extra things that they have to do. They just can take a home buying class and learn about the responsibilities of home buying.
I'm glad to hear about the 3-year help, as far as like if you're a homeowner over 3 years ago, you can still come in and use these support systems, because it was just such a different world 3 years ago.
Right.
So everybody could use a little bit of assistance in today's market for sure. And I think that's interesting that part of the program you said is that they have to take a class about
it's like a counseling class, and they do it online. It takes an hour, but it just tells you, what all, what else you have to, when you buy a house, it's not just you get a house and that's it. There's maintenance involved and budgeting.
Can I get a copy of that? I feel like
can you retroactively apply it? That'd be great.
We probably, it is it's a class that they go online and register for, but we could probably throw some material on your YouTube for it.
That's funny.
Yeah.
Is there a static number that they're able to get back in the grant, or is it a variable number?
So you can borrow 2%, 3%, up to 4% right now. They used to offer 5%. That could come back. It's just a lot of these programs are money that's raised, and then once the money's out, there's a different program. It's called something else. They have a part of it too that's Home for Heroes. So if you're a firefighter, policeman, a teacher, there's that program is built in as well to it, but you also can qualify if you're not a hero, a hometown hero. So it's really geared towards everybody. And it's not the best. It's the best thing to get in the home, because the hardest part about buying a home is down payment. And so most people think you need 20% again, but you don't. There's programs that allow for 3%, and you can get a 4% down payment assistance. So then you have an extra 1% to put towards closing costs.
I'll tell you, I've seen people having to put, because I help people in all spectrums. I don't care if they're luxury home buyers or Section 8 renters. It doesn't matter to me. I have people that are having to put down $7,000-8,000 to lease a place.
Oh,
Oh,
wow.
wow.
It's crazy. And I'm not talking an expensive place. I'm talking a place that is, I mean, expensive is relative, but a place that, let's say it's $2,500, but if their credit doesn't hit well, or the income doesn't look good to the landlord, then, or the property management company, then they might ask for a double security deposit plus first month's rent, plus a pet deposit, plus monthly pet fees. It's like, wow.
Yeah. It
So if you can do
does
that,
add
you
up.
should buy. You should be able to buy it. You should be able, if you want, and this is the right time for you. We should be pushing you in the direction of let's get you something you can own instead of putting all that money into something else.
Right.
For all
Again,
these,
if it fits.
for all these programs that you're discussing and talking about down payment assistance, does the applicant have the option to use those funds towards closing costs and buying down rates instead of down payment, or is it strictly must be down payment only?
So those rates are actually published weekly through the programs. So there's no buying down of the rate.
Okay.
You're taking the rate that is offered. But you can use those funds for down payment and closing costs. So if you still wanted to put 5% down, but get an additional 3%, down payment assistance to help you get the payment where you wanted, you can do that as well. So as long as the program, you're just putting down the down payment that's required, you can use different, the money differently, however you would like it. So I have had people do down payment assistance with 10% down before.
Okay.
They just want that additional funds.
And just so I'm clear, you said this is a payback. This is not a grant, it's a loan.
So there are two options through TSHAC. There is a grant and there is a bond. So the bond is a 3-year forgivable. That is the best pricing right now. So that's what we're doing most of. The grant has gotten a little tougher on qualifications with just the market tightening like it is. But again, that changes monthly with these programs. These programs are constantly changing. With like 1 week, they might offer the better rate on the bond. But then 1 month later, the grant, they might try to be getting rid of, the money. And the grant, you don't have to pay back. The bond is forgivable after 3 years. So if you were to refinance within a year, then you are going to have to pay that money back. But if you do nothing for 3 years, that money is 0 interest. You don't have to pay it back.
Gosh, 3 years is just not that long of a time.
It's not. Trying to think of the word for it, but let's say you moved out in 2 years, you're only going to be paying back 12 months of the bond. You're not paying back the whole thing. Does that make sense?
Are there any rules about, let's say you have to move out because of a job change or something after you purchase the house, your environment change or your situation changed? Are there any rules against them being able to rent it out, or do they have to sell the house, or do they have to pay it back at that point?
Once it's your house, it's your house. Yeah. Just make sure you make that payment on time. But you can, so on any home, if you plan on renting it out within the first year, it's an investment home. But if you live there a year and then you have to move and turn it into an investment home, you can do that on any program.
That's good. At some point during this conversation, I'd want to run maybe some realistic numbers. If you can pull up a calculator and I'm just going to give you like baseline generic stats and we can talk through it. But okay. So that's a great program. Can we revisit? Randy, how do you feel about revisiting the Heroes loan program?
Yeah, absolutely. Yep.
There's a lot of teachers, firefighters, police officers. I remember Christina Smallhorn, who's a pretty big YouTube realtor in Louisiana. She labeled affordability as your standard working class jobs, your firefighters, your police officers, being able to afford a house in that area.
Yeah.
And ever since she said that, I was like, that's a perfect way to articulate that. And so that is such a huge program. And I think that we need to explore it as much as we can. So let's, what do you have?
So I have a question. So like as a real estate agent and with knowing, their income is only a certain amount, like what areas of town are you seeing that popular for them?
For teachers, nowhere.
I was going to say Central is really really challenging. It almost always has to be, or 90%, unless, they're independently, they have a large pool of resources independently, or are in a, what do you call it? A domestic situation where they have a lot of resources or access to a lot of resources, but generally it's outside in the suburbs.
Right.
And even the suburbs are really light on options too, because the salaries are about 55,000. So they better be married in order and combine that income to be able to do something with it.
Yeah, it's tough.
And
So
one of the things too I've noticed is like new home builders, you can have extra incentives for teachers and firefighters and policemen. They'll throw in like an extra bonus credit towards closing costs as well.
That's good. That's good.
So
so
what's the standard program for like the Homes for Hero? Like what is how do they pitch that?
So it's the same. It's the TSHAC program, Home for Heroes. They do get the same options of down payment assistance, the 3, 4, 5% down, 2% down. Some people do take advantage of that 2%. You wouldn't think it'd be worth it, but sometimes that can just help somebody. They think they need, 4,000 more to buy, and instead of waiting a year, they just borrow it, for free in a way. So that's good. But another thing I wanted to throw in there real fast too is something Guaranteed Rate does. When we talk for Home for Heroes is also veterans. Veterans, we actually have no lender costs for veterans. So it's a cheaper mortgage as well. That they're guaranteed.
So 0 lender fees for veteran borrowers is what you're saying.
Yes.
Okay. So this is a hypothetical. Let's say you have a veteran with a 700 credit score. I don't know, very little college debt, like very little debt in any way. They wanted to get a loan. What are they paying out of pocket for a $500,000 house? I know these are estimates.
Okay, so a veteran can also do a VA loan, which is separate from down payment assistance. VA loans are actually they've been around the longest, and they've never had to change their guidelines minimally, really, but they're 100% financing. So they can go to a house and buy it and put 0 money down. They can actually get money back at closing because you can roll in all the closing costs into the sales price. So a veteran can literally get their earnest money back at closing.
And without going too deep into the rates, are the rates generally better or worse?
So VA loans are usually better than like compared to conventional and down payment assistance. So down payment assistance does have its pros and cons. The pro is it helps you get into the home, so you're not buying it a year later at a higher price, but you're taking a higher rate than if you can come up with 3% down payment because you are borrowing the money. So.
Randy, when you work with your veterans, or if you're on the listing side and you're receiving offers from veteran people with a VA loan, it doesn't even from people with the VA loan, are you, during the pandemic, we had a hard time with those?
Yeah, and FHA.
Are you still seeing that happening today?
No, absolutely not. Listings should be happy to take anything that's coming their way. And then actually, I'm doing an interesting thing right now where a current listing I have is a VA loan at 2.75 interest rate. So we're like seeking out veterans at this point that would want to assume that mortgage because
VA loans are assumable. And JJ really wanted to talk about assumable loans today because he had a scenario recently.
It was interesting because we've had 2 interested parties. That's probably my hottest mortgage topic that I'm dealing with right now is people are approaching me now wondering, does your listing have an assumable mortgage? And so this one that has this VA loan, it could be assumed by, and I'm going to pass this off to Trisha, who's going to know way more than me, but my experience thus far was it can be assumed by somebody that's non-VA, but then it puts my clients, the sellers, in a precarious position where the person assuming the loan is not a veteran. And so then that stays on the seller's record with the VA and counts towards how many times they're able to use the VA loans. And then we learned as well that if the buyer were to do that and they were not a veteran, so then the VA loan still stays under my seller's name, and then they go bankrupt or foreclose, that actually like leaves a mark on the seller's name, and then they can't use their VA privileges anymore because a bankruptcy or a foreclosure is now listed underneath that. So something to be very aware of out there with, I think, how much more assumable mortgages are going to come into play at this time is to make sure to check all the fine print and get those details ironed out of, what needs to happen.
I had no idea that it would void your future ability to use a loan if someone else got a foreclosure or bankruptcy on your
Yes,
loan.
just for that VA situation. Yeah.
Wow.
So, but if we also had a veteran inquire about it, and so then we had these two parties talking, and if it was a veteran taking over the VA loan, then that gets transferred over to that veteran's VA file, and so now my seller is clean and free from the property and is not tied to whatever may come for the future of that loan.
That's incredible.
Yeah.
So
Yeah,
Trisha, how?
each
Go ahead. I'm sorry.
Oh, so you're fine. So each veteran has what's called VA eligibility, and they have a certain amount that they can use for their lifetime. Once they get rid of a VA, they have full eligibility again. You can have multiple VA loans at once. Again, a VA loan is only a primary residence. You can't go buy in Texas. You can't go buy an investment home using your VA, but you can leave one property and go buy another one later down the road. Has to be a certain distance away, but you can buy another VA home and use your eligibility again. And then in that situation, they do have like a calculation that, depending on, you get a copy of their certificate of eligibility, which is something that every veteran will have in order to do a VA loan. And it'll let you know how much entitlement they have left over. So in that situation, Randy, when their entitlement was not going to be restored because they were giving their assumable mortgage to somebody else, but on another veteran, it'll be transferred over into their entitlement.
Yes. So any veterans out there, they're looking to shop in Cobb, Texas, have I got a deal for you?
Yeah. So assumable mortgages too is not something I even know a lot about, because that is a servicing thing. Every servicer is different on how they allow for an assumable mortgage. JJ and I did have a client together recently who was going to take over an assumable mortgage, and it was going to take up to 6 months in order to get it done. So that buyer did have to terminate and go under contract on another home because it just wasn't, he didn't have the time to wait on that, but the seller was willing.
Yeah, that's so interesting about the 6 months timeline. The timeline that we received for this particular situation was 45 days. So that's just great. Based from lender to lender, huh? That's so interesting.
Well, servicer to servicer, yes.
Okay.
So servicing is a whole different department than mortgage lending, yeah.
So another important question to write down on a list of how to assume a mortgage is ask how long it's going to take, which we did, but it was 45 days. So I didn't really think twice about it. Of like, okay, that's very average. So 6 months, that's really nuts. So that's an important question to ask and to confirm.
Correct. And they didn't even know if they were going to be able to do it. I think that was a lot of it too, is they just didn't, it was an unknown.
Okay. Was this an FHA loan, or what was the scenario again?
JJ would know. I think it was a VA loan.
Okay.
Could have been an FHA though. Yes.
Well, just to circle back to Ian's original question of, do I remember the days of when FHA and VA wasn't going to fly? I definitely remember that. And I'm so happy that that's one of the positives of today's market, is that people that just simply like FHA or VA is what they're doing, they should be they should be able to go out and hunt for their house and have a fair shot at, everything else, and not be automatically eliminated from the pool. So I'm glad that that's one positive that we have in this very strange market that we're in, is that FHA and VA is back in the game. So
yeah.
What are you seeing for time for VA right now?
So honestly, everybody's closing very fast right now. We are actually averaging 7 to 8 days in clear to close from start to finish. The thing with VA that can take the longest is the appraiser is allowed up to 10 days to do the appraisal report. And there's no like changing that. So that's the only thing with VA. There's a lot of negative things with FHA and VA, but there really isn't, as a lending perspective, they're just as easy as a conventional loan. On our end, VA, has a couple different things that they require as far as like a pest inspection, but most people get that anyway when they do a home inspection. But usually VA just has a longer appraisal turn time, but no one's that busy right now. So those appraisals are coming in just in a week as well as everybody else's.
That's great.
That's good. Okay, so that we talked about first-time buyers. Now, let's say somebody has a home that they're able to sell, but they want to move into a different home. What kinds of programs do we have? Creative financing options do we have for that?
Okay, so are they selling their first home or keeping it?
Let's go with both scenarios. So let's say the first one, they want it, they're going to sell it.
Okay, so on my end, like 2 years ago, there was no contingency clause. You couldn't sell a house and then use the funds to buy a house. You had to be able to buy a house, qualify with the other house, come up with your own down payment, and still qualify and close on time to be even looked at, correct?
Mm-hmm. Yep.
Okay. So now I have seen a lot more contingencies where the seller allows you to sell your house before you close on theirs.
Mm-hmm.
And so in that scenario, obviously you're using the equity to put down. We also are using that equity to pay off debt, which that allows you to upgrade your home, right? So now your mortgage payment's going up $1,000 because you're buying a bigger home, but you're making money off this home. Let's pay off that $1,000 car payment, and then you're even, Steven.
Oh,
right?
Yeah, that's great.
Yeah, that's clever, obviously.
So let's put less money down on the new home, but let's pay off debt. Because the problem right now with most of our clients is debt. Debt's gone up. It's going up. Everything is a lot more expensive. More credit is being lended. So we are really we try to call ourselves financial wellness advisors, how to make your life easier. The last thing we want to do is have somebody move in and be house poor. We want them to be comfortable. So if we can tackle debt at closing, we will. And you can pay off debt on the closing disclosure. So I don't know if you see that a lot on your end, but you can sell a house, close the next day on the new house, and pay off all your debt at the same time.
Yeah, it's been a minute since I've had a client that's done that, but yeah, that's a good one.
We're making a lot of people pay off debt right now.
Oh, well, I was thinking that. I was thinking with the rates the way they are, more people are probably going to have to do that, especially if they've had auto loans in the last couple of years. And I'm guessing that a lot of people ended up getting auto loans during the pandemic, changing up their travel.
Right.
Just because the travel thing.
So think about it this way: you're getting a loan. It's, let's say, 6.875 today, but your credit card debt is at 25%. Let's borrow. Let's pay less down on your new house. Borrow more at 6.875. Pay off that high interest debt
from the equity of your current home.
From the equity of your current home.
Assuming you have equity.
Assuming you have equity. And if you bought in Austin 2 years ago.
Which some people, that is not the case.
Well, so the thing is, I just want to help everybody understand this, who's watching right now. If you bought a home in Austin during the pandemic and you paid a little bit more, it's not necessarily that your home is worth less. That's not necessarily what anybody's saying. But when you factor in the costs of doing business to offload your home, the time it takes, the opportunity cost, then it starts to be a different story. There starts to be a different story around it. So that's why we keep circling back on that topic. JJ, what's up, man?
What's up, JJ?
Frozen.
Listen, it's 123 degrees out right now. You cannot be frozen. There you go. You're back.
Am I frozen?
No, you're good.
Not anymore.
So we were talking to
Oh my
Trisha about FHA, Homes for Heroes, and then I think you wanted to talk to her about assumable loan sum. Do you want to jump into that? She mentioned it a little bit, but there might be something specific that you wanted to refer to.
Maybe not that so much, but what are you seeing in the market, Trisha? Like with creative loans, or what's different nowadays?
So we're not seeing a lot of jumbo buyers. We're seeing a lot of first-time home buyers. It does remind me a little bit of my subprime days, getting real
Trisha,
creative.
what's the cutoff for jumbo for everybody? Approximate.
I have it written
Approximate.
down. I always forget. Well, it's a weird number. It's not over here. It's like 737 200. If I'm gonna guess.
It just changed in the last year or two, right?
It did. It's high now. It's high.
Yeah.
So I mean, you can get, and FHA's gone up too. There's a limit on FHA per county, and it's gone up too. I mean, you can buy like a $500,000 house now with going through FHA. So
what you're saying is that if it's $1 million home, there are less of those being sold right now or coming through your books.
There's the lending on them has gotten tough. A lot of those banks. So what's happening is during COVID, the government came out and said we're backing Fannie and Freddie, but we're not backing banks. And so banks are being real strict on what they're lending on. I mean, commercial lending, small business lending, they're being very picky. You've seen banks go under, you've seen banks merge. There's a lot of banks that are not lending as much as they are. So when it comes to jumbo financing, it is a lot stricter. And now the rates are not as good. And nobody really wants to do ARM products right now as far as lending a lender, because they know rates are going to drop, right? Doesn't mean they're not available. They're still available. They're still not a bad program, but they're not as common. And
I have a question on that, Trisha, before we move on from it. Is that why right now ARM loans don't really have that competitive of a rate? Because there's okay, that's interesting. Because I keep going back to that with my clients. I was like, have you checked in on the ARMs? Have you checked in on the ARMs? It's kind of a good time to do that. And he's like, well, it just wasn't a very competitive rate. So I moved on from learning more about if I wanted to be a part of that or not.
For people that are watching, and this might be one of their first times watching this podcast or any real estate related podcast, can you explain how an adjustable rate mortgage works, or what it is?
Yes. So there's different adjustable rate terms. There's usually a 3-year, 5-year, 7-year, or 10-year option. And that means 3-year, 5-year, 7-year, 10-year are all fixed. And then after that, the rate can adjust. And now the rates can adjust every 6 months. They used to be yearly, but right now a lot of the ARMs are 6-month adjustable ARMs. So every 6 months they can adjust.
Okay, and that means they can go which direction?
Up or down.
After that initial 3, 6, 10 years.
Exactly. So when rates started to go up, when inflation numbers, were high, we're trying to fight the battle, ARMs were a good product because it still was affordable lending. But now we've been 11 months straight on the Fed funds rate going up. So we're hopefully at the end of it, the numbers are all starting to come back positively of us fighting inflation. But now that is a good thing for fixed, rates coming down and refinancing hopefully coming soon within the next couple of years, ARMs aren't a hot topic product. Because investors don't want to buy those loans because they know those people aren't going to be there maybe in 6 months or a year. And they don't make money unless people pay interest for 30 years. So
one of my questions is how do builders still get away with it then? Because right now you'll see that they'll give a lot of stuff, a lot of incentives to the buyer and still help them either buy down their rate or give them some kind of ARM product?
So builders are in a different boat. So they control their pricing. So instead of a seller who's buying, selling their resale home, which is an existing home, you have to lower the price. But a builder doesn't want to lower the price, because then for future sales in that neighborhood that's not built out, they're going to lose way more money if they lower that sales price. So instead, they offer incentives to make it more affordable to purchase. They offer bonuses for agents, and they offer incentives for the client. So they're throwing in designer credits, they're throwing in closing cost help, they're buying down the rate. So they're doing that strategically because they would rather do that. They're going to offering 15,000 instead of lowering it 30,000. They're still going to, profit.
Which is a really important detail for sellers and homeowners out there to realize when you're researching maybe selling your house, and if you live next door to a new construction community and you're receiving some sold information maybe from your realtor, and you feel like, well, that neighborhood's doing great, they sold at that price, and that's what I want to list my price at. But there's a lot going on behind that closed price that they did not get that full $400,000 closed sale price. There's concessions and the designers, and that's exactly what she was mentioning there before. They've done so much in concessions that doesn't immediately show up in that closed sales price that you can't use that as a true comp almost.
Yeah, especially when the neighborhood's like right across the street. It's like they're very close, very close. This section might be 2 years old. That section might be new construction, and people are trying to compare them. And it's like, that's not really a fair comparison, especially if you're selling, like you said.
Yeah. And also too, when you do see advertised really low rates, buy down rates, those are usually forward commitments that the builders are paying for with lenders. They're buying a certain amount of homes, say $2 to $10 million worth of homes, however much they have to sell. And they're saying, let's advertise this rate. We're buying it down. And it's a commitment that they're giving the lender to help them sell. Okay. And that's something we offer. So if you guys know any builders that need help selling,
okay,
offer those kind of programs to help them sell. Because right now, everyone needs a strategy, whether you're a builder or a real estate agent. Homes just aren't flying off the shelves like they used to.
Yeah.
Okay, so we talked about sellers that do have equity and they're willing to sell their house. What about the ones that need to stay in their house? Or keep their home while they're buying a new one. So they want to turn that home into an investment. I think that's
I am seeing a lot of, so in that case, you can get as low as 3.5% FHA or a 5% down conventional. So at that point, they have some money saved, usually those homeowners. If not, you can pull from investments. I think a lot of people don't realize you can borrow against your 401k. You can get a gift from a family member or a relative. There's ways to leverage money other places in order to use it for down payment on a home. So you're just putting less money down, right? You're not putting the 20% down. And so what's really cool about that scenario too is if you're going to rent out your home, as long as you get a lease agreement and you have 1 month security deposit, then we can offset that debt. We can't use that as income, but we can offset that mortgage.
That's interesting. So it is an item to consider about getting a lease in place before trying to apply for your next mortgage. If you're able to.
No, you can do it all simultaneously. Use the agent you're working with, have them help you find somebody to lease it. It can't be a family member.
Okay.
Yes.
Interesting.
In case y'all were wondering.
So curious, did y'all talk about buy down points?
We did a little bit. What did you have a specific comment or question on that?
It could probably be a good finale.
Yeah.
Yeah, we're talking about, because you're talking about like adjustable rate, but not specifically buy down points.
Right.
But after
we
buying
have
down,
we have not gotten into buy down points.
Yeah, sorry. I said it for some reason I thought that we had talked about it, but no, you're right. I think that is another really good one.
So, okay, let me do my spiel on this.
That's still trending, right?
Pricing can get it can get confusing, and I try to keep it simple for people. So there's
It can get
two
confusing.
so buy down is buying down the rate. But right now, what's popular is called the temporary buy down. But the regular
broke
buy
up a little bit. Can you say that again? What's popular?
The temporary buy down.
Temporary buy down. Thank you.
Is a temporary buy down. And this is what builders are offering, and this is what sellers are offering. For homes that aren't moving, they're offering a $10,000 credit towards closing costs. You want to use that to help buy down the rate. So temporary buy downs, there's so many options we have, but we have a 2-year buy down, a 1-year buy down, 1.5-year buy down, a 3-year buy down. We have a ton of options. But let's talk about the 2-1 buy down. So a 2-1 buy down, so let's say the rate again today is 6.875, just saying a rate, and you want to do the 2-year buy down. That means you're going to get 2 points less the first year. So you're actually going to get a 4.875 the first year, a 5.875 the second year, and then the third year to the 30 year is a 6.875. The reason these are popular is because we know rates are going to come down. And so the goal would be to refinance by the time you hit year 3. And this buy down is whatever you're saving monthly is added up for those 2 years, and the seller's paying that up front for you. So I had a scenario yesterday. The client is buying, JJ, it's your client. He's buying about a $480,000 house, and he is getting a lot of money from the seller, probably around $14,000 from the seller. And he wants to do the 2-year buy down. So in our scenario just now, we could get him a 4.875. If he were to just do a regular buy down and just buy down the rate permanently, not the temporary one, we can only get him down to 5.875. So yesterday it cost, on that scenario, $14,000 for him to buy down to 5.875. But it's a 5.875 for 30 years. But who wants to do that? Because he could save an additional $250 a month if he were to go the other direction the first year. So they're popular, and that's why you're seeing a lot of incentives being thrown at these deals, because that's a very popular product right now.
I get so nervous with the temporary buy downs because I think they were really popular when they, came right out of the gate with that, last October when everything went to hell. But here we are like almost a year past that, and the interest rates are still at 7%. So I feel like people keep saying the rates are going to come down, but they're not. So
well, we have to fight inflation. So that's the key. But I will tell you, last year, if they would have locked in, they were at a better rate than they are today. So they're actually better off today in a year from when they purchased this year than they would have been if they just waited a year.
Yeah.
I understand your concern though, because you do want to make, obviously your payment's going to go up each year, the first 2 years in that scenario. But right now, what is hard about people buying is we go back to affordability. It's all about affordability. And if you can save money and get in the home, at least get comfortable with the home, the payment, knowing it's going to go up, then you can strategize other ways. Let's pay off debt here. Let's cut costs going out to eat here, that kind of thing, for preparing for the future.
That's a good point, Trisha. Yeah.
So I have a question for you. Do you foresee any issues? And I'm asking this for some people that watch this show pretty regularly. Do you foresee any issues with student debt rearing its ugly head in the next couple of months? Do you think that's going to affect people being able to get loans here in the near future?
So we do. I think what a lot of people don't know is that we do have to use student debt against your debt to income ratio, qualifying you, even if you're not making any payments. or have made any payments or have to make any payments in the future. Fannie Mae and FHA make you use 1% of the balance. And because a lot of the times the credit report's not showing any kind of balance. So Fannie Mae and FHA make you use 1%, and Freddie Mac only makes you use 0.5%. So someone with a lot of student loans, I really want to take them conventional and take them Freddie because of that reason. Or they can consolidate their loans, pick a payment, pick the lowest payment you can while you're getting a mortgage, and we use that amount. So I see a lot of student loan debt. There's a lot of student loan debt out there. I think it has gotten a little stricter just with the 1% because we used to not have to include it. VA actually is probably the nicest with student loan debt because you can get away with not including it. But it is something I'm seeing a lot of, and I think colleges are just getting more and more expensive. So I don't see that going down, unfortunately. I think trade schools is where it's at.
Anybody with student debt out there, make sure that you hop on a computer and Google their new program that they just released in this last legislation this last year of the income-based repayment, which most people are on, but make sure that you're on this particular one. And I'm so sorry, I can't think of what the name of it is, but it's by somebody's done the research. Texas Tribune did a great article about it, and it's by far the best repayment plan out of any of them. And you should get on it immediately. So it's a new,
it's like zero interest or something for X amount of time.
It just has looser restrictions throughout the whole thing. So it's just it's definitely the way to go. It's them trying to, push down this bear of student loan forgiveness. So yeah, income driven repayment plans, which most people know to be on, but there's a particular update that they just made this year, and you want to make sure that you request to switch over to the new one. And it's very beneficial for so many ways, depending on what your file is like. So it wouldn't even almost be worth it for me to start explaining it if I could even remember. I read the article about a month ago.
That's interesting because I just had a client who had a lot of student loans, and when they were going to consolidate it, the interest rate was going to jump. So that's good to know that there's something out there that would keep it lower.
Yeah. Yeah. There's definitely a lot of benefits coming out with it. I think it's the repay one, REPAYE, or maybe that's the old one. And so now you switch over to this new one. But anyways, if you just do a simple Google and maybe put it Texas Tribune, they did a great article on it.
JJ, any other questions for Tricia or anything else you want to share?
I was just curious if are y'all still trending and using buy down points for your clients?
Mm-hmm. I feel like there's no other way. Taking on a 7% mortgage rate is nuts. I don't know. Do you guys have clients that are not addressing buying down the points in some way with either themselves or having the seller put concessions towards it?
I think every client I have has asked the question.
Yeah.
At the very least, hey, can we buy down?
And some people
makes sense to buy down points.
Yeah, some people would rather just take the cash and put it towards closing costs because they're either remodeling and they're going to refinance and throw more money at it after they sell their house, or the home is going to appreciate when they refinance. They're not going to have mortgage insurance anymore. I mean, there's the saying, I know a lot of people are sick of it, date the rate, marry the house. But I mean, I purchased my first home in Austin, 2006. I was in mortgage at the time, got the best rate out there. I was at 7%. So it's not a bad rate. When I started, we were in 15 to 18%. So, we're still in the sixes. So we moved 6 to 7. So it's still historically low. I read an article the other day about good debt and bad debt. And this one financial advisor mentioned, instead of paying off debt, if the debt's under 7%, keep it and invest the rest. because you can grow your money by investing. So
You can make more than 7% in most cases.
You can.
Even the high yield savings are what, 4.5% right now. It's like you don't do anything. You're not even investing really. You're
Yeah.
making that.
Yeah. And I don't know if you guys have had this on your podcast, but this year, you know, the worse your credit, the less you put down, actually better your rate. So if you can't be discouraged right now, because right now you can actually get a better interest rate than someone who has who's putting 20% down. So
Which is
crazy.
definitely a controversial conversation.
It's
I think we did mention it at some point, like we just glossed over it. But I don't think we've had an in-depth conversation. But
Well, they did away with it, right? It was so unpopular that they actually like dialed it back. Am I wrong on that? Didn't they?
No, it's still in effect. Yeah. So there's risk and rates, right? So used to when the loan was riskier, it was a higher rate. And that still is a scenario in some loan programs. But in the conventional world, it's if you're not getting hit hard with loan level price adjustments if you have a lower score, you're a first time home buyer, and you're putting less down. You're actually getting the same, like a better rate. But it is helping with affordability.
How long is this policy going for?
I think they're just trying to make it affordable for people to still get in, because it's tough times right now. We're seeing a lot lower credit scores. I'd be curious what the average credit score is right now in the nation. It used to be 680 a while ago. So I feel like it's gone down.
I thought,
and
I don't know.
I think that's super interesting that that's still around, that there's no knowledge that it's going to change anytime soon. And I think the big problem is, one, you've got affordability on one hand, and people need to be able to get houses because that's how society and the economy works, right? Like that's a big part of it. But also on the other end, you have these people that have worked so hard to make sure they have good credit scores, pay their debt, and also are able to, and hopes that they will be rewarded fairly with lower interest rates. And there's an imbalance there. That's a rough one. It
is a rough one.
Anyway, I think that's it. Unless y'all have something exciting to say, y'all want to do a round table? What do you have, Randy?
No,
Anything
that's
exciting?
it.
JJ,
I am like ending on a positive note.
Yeah, please.
You never know until you talk to a loan officer what you're capable of. So just make the phone call, make the connection, and just we've heard every scenario. So we want, our goal is to get every single person in a home. We love the feeling of helping people get there. I've worked with people years. I know JJ has too. It can take time. It's a big purchase. It's your biggest purchase you'll ever make. And so don't be overwhelmed and discouraged, because there are people that are there to shoot you straight and tell you exactly how to get there. So I do think that just talking to the right people who know the area, the agents, like where you can afford, driving around, talking to builders, just getting an idea.
I love it. All right, y'all. Thank you, everybody, for hanging out with us, and we will see you again in a little while. Let us know in the comments if you have anything that you want us to focus on in the next couple of weeks. Trisha, thank you so much for joining us.
Thanks, Trisha.
Thank you.
Thanks, Trisha. Everybody.
Y'all.
Bye.